On March 17th, the United States government did something it has never done before. It looked at 16 cryptocurrencies by name and said, "These aren't securities, they're commodities." That single sentence just ended a decade of regulatory warfare. It opens the floodgates for ETFs, unlocks institutional money that's been sitting on the sidelines, and fundamentally changes what it means to hold, trade, and build on these networks. But here's what nobody's telling you. This ruling also has a catch, one that could let the next administration reverse everything. And whether that happens depends on a single bill sitting in the Senate right now. In the next 10 minutes, I'm going to break down exactly what this ruling says, walk through all 16 cryptos on the list, explain what commodity versus security actually means for your wallet, and give you 3 things you should do right now. Let's get into it. Here's what went down. The SEC and the CFTC, America's 2 most powerful financial regulators, jointly published a 68-page interpretive release. Release number 3-11412. That's the official document number. You can look up yourself. SEC Chairman Paul Atkins and CFTC Chairman Michael Selig signed it together. That alone is historic. These 2 agencies have been fighting over crypto jurisdiction for years, and now they're on the same page. Literally. The release does 3 major things. First, it creates a 5-category token taxonomy. Every crypto asset now falls into one of 5 buckets: digital commodity, digital collectible, digital tool, stablecoin, or digital security. Second, it names 16 specific tokens as digital commodities, not securities. Commodities. That means they fall under the CFTC, not the SEC. And third, it explicitly clears staking, mining, airdrops, and token wrapping from securities law. If you're staking your ETH or SOL, the government is now saying that is not a securities offering. Chairman Atkins put it bluntly. After more than a decade of uncertainty, this interpretation will provide market participants with a clear understanding of how the Commission treats crypto assets. This is what regulatory agencies are supposed to do: draw clear lines in clear terms. Now, those 16 tokens. Let's go through every single one. The ruling names 16 specific crypto assets as digital commodities. I'm going to group them so this makes sense. First, the established giants, Bitcoin, Ethereum, and XRP. These 3 were widely expected. Bitcoin has been treated as a commodity informally since 2015. Ethereum's commodity status was debated for years. And XRP, after a 4-year legal battle with the SEC that started in December 2020, Ripple's chief legal officer responded to the ruling by saying, and I'm paraphrasing, "We always knew XRP wasn't a security. Now the SEC agrees." Next, the smart contract platforms: Solana, Cardano, Avalanche, Polkadot, and Aptos. These are the Layer 1 blockchains, the infrastructure of Web 3. Solana and Cardano getting commodity status is huge for DeFi builders. Polkadot and Avalanche are interoperability plays, and Aptos is the newest name on the list. It launched in 2022, and getting classified this early is a strong signal. Then, infrastructure and utility: Chainlink, Stellar, Hedera, Litecoin, Tezos, and Bitcoin Cash. Chainlink powers Oracle networks that feed real-world data into smart contracts. Stellar focuses on cross-border payments. Hedera is an enterprise-grade distributed ledger. Litecoin and Bitcoin Cash are Bitcoin spin-offs, and Tezos is a self-amending blockchain that's been quietly building for years. But here's the part that caught everyone off guard: Dogecoin and Shiba Inu. Yes, meme coins are now officially classified as commodities under federal law. That surprised a lot of people, but it makes sense when you understand how the ruling defines a commodity. A digital commodity, under this framework, is a crypto asset whose value comes from the operation of a functional blockchain and supply and demand dynamics, not from expectations of profit driven by a central team. Dogecoin runs on its own proof-of-work chain. Shiba Inu is an ERC20 token on Ethereum. Neither one has a founding team making promises about returns. That's the key distinction. Okay, so 16 cryptos are now commodities. But what does that actually mean for you? Let's break down the real-world difference. If a crypto is a security, it falls under the SEC. That means heavy regulation. Exchanges need to register as securities exchanges. Tokens might need to go through a registration process. And the SEC can, and did, under the previous chair, sue exchanges and projects for selling unregistered securities. If a crypto is a commodity, it falls under the CFTC. The CFTC regulates derivatives and futures, but has historically taken a lighter touch on spot markets. That means exchanges can list these 16 tokens without SEC enforcement risk. It means compliance departments at major institutions can finally approve exposure to assets like Solana, Cardano, and Chainlink. And here's the catch I mentioned at the top. This ruling is an interpretation. It carries the weight of federal law, but it's not legislation. It can be reversed by a future administration. That's where the Clarity Act comes in. It's a bill that would codify this exact commodity versus security framework into permanent law. It passed the House 294 to 134 in July 2025. It's cleared the Senate Agriculture Committee, but it still needs to pass the full Senate and get signed. Prediction markets give it about a 72% chance of becoming law in 2026. Until it does, this framework is strong, but it's not permanent. Let's get practical. 3 areas where this ruling changes things immediately. First, ETFs are now unblocked. Before this ruling, any spot ETF beyond Bitcoin and Ethereum faced a fundamental legal question. Is this asset a security? If yes, the ETF structure doesn't work the same way. That question is now answered for 16 assets. For context, spot Bitcoin ETFs have pulled in about $87 billion in total assets under management. In the first 2 weeks of March alone, they saw $568 million in net inflows. That's institutional money moving at scale. XRP spot ETFs are already live and have attracted $1.44 billion. Now imagine that same pipeline opening for Solana, Cardano, Chainlink, and the rest of this list. Second, staking products go mainstream. The ruling explicitly says protocol staking is not a securities offering. That's massive. It means regulated platforms can offer staking products without worrying about SEC enforcement. Expect major custodians to roll out institutional staking within 90 days. It also clears the path for staking-enabled ETFs. Imagine an Ethereum ETF that earns staking yield for holders. Now here's the thing that most crypto influencers are getting wrong about this ruling. Third, your taxes haven't changed. The SEC and the IRS are different agencies. The SEC decides what crypto is. The IRS decides how it's taxed. And the IRS classified crypto as property back in 2014. Nothing in this ruling changes that. Capital gains rules still apply. Short-term gains are still taxed as ordinary income. Long-term gains still get the lower rate if you hold for over a year. There's one exception worth watching. If commodity-classified crypto futures expand, and they will, those contracts get Section 1256 treatment. That's the 60-40 rule. 60% of gains taxed as long-term, 40% as short-term, regardless of holding period. That's a better deal for active traders. But for spot holdings, same rules as before. So, what should you actually do with this information? 3 things. Move number 1, understand what you hold. Check your portfolio against the list of 16. If you hold any of these assets, your regulatory risk just dropped significantly. Exchanges are less likely to delist them. Institutional buyers are more likely to enter the market, and the legal cloud that hung over assets like XRP and Solana for years is gone. If you hold tokens that aren't on this list, that doesn't mean they're securities. It means they don't have clarity yet. More classifications are expected, but right now, those 16 are the ones with a green light. Move number 2, watch the Clarity Act. This is the single most important variable in crypto regulation right now. If the Clarity Act passes, this framework becomes permanent law. If it doesn't, a future SEC chair could theoretically walk it back. Track the bill, know when the Senate Banking Committee schedules the markup. This is where the long game gets decided. Move number 3, don't FOMO. Position for the long game. Every time there's a big crypto headline, the temptation is to rush in. And yes, this ruling is genuinely bullish. Institutional staking products, new ETFs, clearer regulations, and billions of dollars in sidelined capital now have a reason to enter. But the crypto market is still volatile. The ruling itself is still an interpretation, not permanent legislation. And this isn't investment advice. I'm not a financial advisor, and nobody can predict short-term price movements. What I can tell you is that the best-positioned investors in crypto have always been the ones who understood the fundamentals, managed their risk, and didn't chase headlines. The smart play isn't to panic buy every token on the list. It's to understand why they're on the list and what that means for where this market is going over the next 12 to 24 months. Let's zoom out. For over a decade, the crypto industry has been asking the US government one question: tell us the rules. On March 17, 2026, the SEC and CFTC answered, 68 pages, 16 tokens, 5 categories, and a framework that, if Congress backs it up, could define the next era of digital finance. This is the moment the regulatory picture started to come into focus. The question now isn't whether crypto has a place in the financial system, it's how fast everything moves from here. If you want clear, no-hype analysis of what's actually happening in crypto, not predictions, not moon calls, just real information you can use, subscribe.